market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Trump and tech definitely dominating the news this morning. In a moment, we'll talk NVIDIA with Bloomberg's Peter Elstrom. But first, let's bring you the latest on Donald Trump's foreign policy threats. Now, in a freewheeling press conference, the president-elect said he would use economic force to make Canada a part of the United States. He also said he would rename the Gulf of Mexico as the Gulf of America and declined to rule out using force to seize the Panama Canal and Greenland.
Can you assure the world that as you try to get control of these areas, you are not going to use military or economic coercion?
No.
And can you?
I can't assure you. You're talking about Panama and Greenland. No, I can't assure you on either of those two. But I can say this. We need them for economic security.
Well, Panama has already vowed not to give up the shipping channel. Denmark saying while it welcomes U.S. investment in Greenland, the world's largest island is not for sale. So let's bring in Ross Matheson, Bloomberg's EMEA news director, and then we'll talk with Peter Elstrom about everything tech. So thank you both for joining us. Ross, it was kind of like a wild press conference because you don't know what's policy, you don't know what's legal, you don't know what's kind of setting the tone. So how should we have taken the press conference?
It was vintage Donald Trump in a way. It's very reminiscent of his first term, where often in press conferences he will range over multiple topics in quickfire fashion: domestic politics, the state of the world, the state of his businesses. And it's very much a question of reading through all of that for what is tangible, because often it's a lot of rhetoric, and in the middle of that there'll be an actual policy announcement or position. So filtering all of that is quite difficult. But what's very clear from this press conference when it comes to foreign policy, at least, is that he's very much going to be tying everything in foreign policy for what he sees as the best interests of the US and the US doing deals, for the US economy. So it's all about putting these comments out, putting these threats out. Does he really intend to use military force against Greenland? No. But it's about going to the extreme with his comments to create leverage for him to extract concessions from countries when it comes to the US. And that's really what that's all about.
And Ross, it will make it very complicated for Canada and Mexico, the neighbors of the United States. I mean, Canada, we saw the news yesterday with Trudeau stepping down. How did leaders, either incoming leaders or leaders at the moment, deal with his rhetoric?
Well, that's the question, because you've got, of course, your domestic considerations here. You can't be seen to be bending to everything that Trump says. Equally, you need to manage the US relationship. For a lot of countries, US relationship economically, trade, investment, markets is important. You can't ignore it. And so how do you thread the needle between, in a way, giving Donald Trump some of the things he wants, that he can claim a win, he can say, look what I got from you, while also holding your ground on things that are really important to you. So for leaders, be it in allies like Canada, who are right next door, countries that are seen as adversaries of the US, like China, Europe very much, a long-standing ally of the US. How do you do that where you seem to be not bending too much to Trump, but you are giving him enough that he can claim a win?
Yeah, and I've heard from, insiders that actually he's taking so much space that they worry that their leaders will spend too much time dealing with Donald Trump and not about domestic policies. Let's also talk about tech. NVIDIA shares falling more than 6% yesterday after a presentation by company chief executive Jen-Hsun actually failed to give the near-term upside that some investors were seeking. So if you look at pre-market, it's gaining some 1.5%, but not the stellar gains that maybe some analysts were expecting. Hsun also spoke to Bloomberg Technology in a wide-ranging interview, saying he would happily meet with President-elect Donald Trump.
I'd be delighted to go see him.
Have you been invited?
Not yet, but I would be delighted to go see him and congratulate him and do everything we can to help this administration succeed.
So let's also bring in Bloomberg's executive editor for global technology, Peter Elstrom, who joins Roz and I. Peter, thank you for joining us. I mean, I guess the concern again is if you're a big tech CEO at the moment, do you need to go and kiss the ring in Mar-a-Lago to make sure that Donald Trump doesn't take action against you?
Well,
tech executives, business leaders more broadly, are certainly paying attention to all the things that Roz is mentioning here. That Donald Trump is out there making proclamations that we just haven't heard from a U.S. president in the past, making these kinds of statements. And CEOs like Jen-Hsun will talk a bit about Mark Zuckerberg also at Mette. They're paying very close attention to what's going on. They are making donations to the inauguration committee. They're going and talking policy with them. They're making some adjustments internally also to make sure that they're orientated as this Republican administration is coming into office later on this month. So they're very aware of the importance of these kinds of policies, and they're trying to position themselves to do as well as they can going forward. We heard that from NVIDIA. Jen-Hsun said he'd very happily meet with President Trump. They have a lot of business that they have to do with China in particular, and they want to make sure that they can adjust as much as they can to keep that business flowing.
So Mark Zuckerberg gave the speech yesterday that he posted everywhere, basically saying that they'll get rid of the 40,000 moderators because of free speech, which means that you don't have a curated content on whether it's fake news or not, but contributors will be able to do that. I mean, is that pandering to Donald Trump?
It's certainly a nod to the Republican administration that's coming in. They had a range of fact checkers that would look after all sorts of content. And realize tech companies have made a kind of elegant solution here where they don't handle this fact-checking themselves. They hire outsiders to handle it, so they have somebody to blame if anything goes wrong. Right now, Mark Zuckerberg is saying they've been too politically biased. They've been doing things that we don't agree with. It's unclear whether that's actually the case because, of course, they had control over this relationship. But there were cases where they were keeping certain discussions around, say, COVID or right-wing extremism. They were keeping that off of the platform that drew a lot of fire from the Republican administration. So now Zuckerberg is saying, hey, we're going to do exactly what X is doing, what Elon Musk has been doing at X, where you can say almost anything that you want, and we're going to let the community discuss whether it's accurate or not accurate. Zuckerberg even said, we're going to try to fight this wave of censorship with President Trump. He wants to be able to get the Republicans on board with this idea. So certainly, yeah, it's a nod to the Trump administration.
And Bloomberg Pursuits actually also spotted he was wearing a 900,000 watch. I mean, Bloomberg Pursuits is a arm that looks at luxury goods. So really quite amazing spot.
I didn't know watches got that expensive, but yeah, maybe that was a little bit of a distraction from his central message.
Yeah, I didn't either that you could buy one for 900,000. Is there basically policy, changing without Donald Trump really doing anything, because a lot of chief executives may want to align. So before they get told, they change how they operate to make sure that they have the Trump administration on side.
We know that was happening even before the election, in a way, during the campaign. I mean, we saw companies, we saw administrations sending delegations to the US trying to work out, A, is Donald Trump going to win? And B, how do you deal with the second Donald Trump administration? So really trying to prepare themselves for months last year for this eventuality. And, of course, perhaps taking policy decisions ahead of that to show, yes, we are sending money to the US. Yes, we're investing money here. We're keeping some production here or returning some production to the US. At the same time, we still want to be able to invest and do business overseas, be it a US company or whatever. So they're trying to show, again, it's all about showing, that you're doing something. And, smart companies, as Peter was saying, are kind of preparing for that already. Certain administrations are trying to show that. So they're trying to thread the needle, really, to be able to, stay out of Donald Trump's crosshairs, because, as you can see, like Denmark, you don't want to be in them relentlessly with Donald Trump at the moment. So stay under the radar, give him a few things that he wants, but also generally be able to set your own policy.
Thank you both for joining us. Peter Elstrom, Bloomberg's executive editor for global technology, and Roz Matheson, our EMEA news director. Now, coming up, we'll look at the impact of Trump's foreign policy threat on markets. That's next, and this is Bloomberg. Well, the U.S. president-elect's tariff threats and policy plans continue to dominate the economic landscape, and investors are trying to make sense of what they mean for markets. So let's discuss all of this with Derek Halpenny, head of research for global markets, EMEA, and international securities at MUFG, and Catharine Neiss, chief European economist at PGIM Fixed Income. So thank you both for joining us. Happy 2025. There's a lot to try and wade through, Catherine, which is like Trump policies, tariffs, and inflation. I mean, at the end of the day, are we only going to have a good new year if there's inflation's under control, and how much is that dependent on Trump policies?
You know, one thing that I often think of is Q1 has been sending us curveballs for a number of years over the last 10 years. So I remember we had Snowmageddon, we had the longest government shutdown, and then it just seemed to get bigger and bigger challenges hitting us, Ukraine war, tariff wars. So you do wonder a little bit, what's Q1 going to throw at us this year? I mean, to start off with, though, things look like we're going to see a bit more of the same in 2025 relative to 2024. Decent, subpar, but decent growth, inflation coming back to target. But there are these big risks. And some regions are definitely more vulnerable than others, Europe being an obvious region that I cover and look at that is vulnerable to these tariff threats.
Yeah, and that actually changes everything also for Eurodollar. If you have a U.S. exceptionalism, what does that mean for dollar going forward, Derek?
Well, I think the key point to make for the start of the year is what's happened in Q4. So we've had an 8% strengthening of the US dollar, euro dollar specifically, 112 down to below 104, 103. So there's been a big move. So I think from a tariff perspective, you've done nearly 10% of dollar strength, which would take care of a 10% tariff, if you like. When you look at the rates market, I would also say that quite a lot is priced in terms of that divergence in economic performance between the US and Europe. And where I would say I'm a bit concerned in terms of the relative pricing is there's a lot of expectations that this US exceptionalism is going to continue in 2025, but we shouldn't ignore the forces of economic cycles, and the restrictiveness of monetary policy is still there in the US. And I think later this year, we could start to see more evidence of slowdown in the US, and that's not priced.
Yeah, Catherine, what do you think is priced in? I mean, again, fixed income has behaved a little bit differently to other asset classes, but there does seem to be this, belief held in the markets that actually the US wins and everybody else loses.
So if you look at the U.S. economy, it's true that top down, the theme has definitely been surprising resilience. But, as has been mentioned, if you look under the hood, if you look at some of the more granular data, you are seeing that cyclical weakness. You are seeing that sensitivity to restrictive rates that is going to continue. And so I think there is this risk that, maybe the economy is going to slow a little bit more than what markets have been expecting. They have sort of oscillated around extremes of, if the data comes a little bit weaker, it starts to price in these huge number of cuts. And if the data comes in stronger, they all get priced out. And maybe the truth is going to end up somewhere a little bit more in the middle. So at the minute, I think we've got, less than 2 cuts priced in for 2025. Maybe, the reality is going to be something more like 3 cuts. So not hugely different, not a massive, aggressive cutting cycle ahead of us, but a little bit more than what is priced in, more softness there, I think, than's priced in.
Derek, I mean, it's unclear at the moment what Donald Trump says is actual policy or if it's just his thoughts. So yesterday he said something about interest rates being too high. I mean, will markets move on things like that? Or are we bracing for, a Fed showdown?
I think markets are fully expecting these kind of comments and verbal interference, let's call it. I think markets will become concerned perhaps later this year when maybe then we start to get an impression from Trump in terms of who he might be picking to take over from Powell in 2026. And that starts to become priced potentially in late 2025. And that's an issue where I think markets could start to respond. Other than that, if he truly believes rates are too high or the dollar's too strong, well, look at your own policies, obviously. And that's what's being priced in at the moment. So if there's a shift in policy because of that, then that's obviously more meaningful.
I mean, I don't know whether you can tell whether he wants and will put policies in place to lower dollar. Is that impossible? I mean, it feels like the impossible question to understand how far he'd go.
Well, the only obvious near-term risk of the dollar reversing weaker is that come inauguration and the days following, the tariff announcements are actually less aggressive than what's priced into the market.
Yeah.
And we saw a little snapshot of that with the Washington Post article suggesting that dollar dropped 1% very, very quickly. Of course, then Trump denied it, and we've reversed a good bit of that. So there's your near-term risk. It's policy-related. Perhaps he's less aggressive. But certainly, listening to him in Mar-a-Lago yesterday, if anything, he looks to be going more gung-ho, and he seems to really believe in tariffs. So I'd be surprised if he doesn't go full-on and kind of meet the market expectations in terms of what's priced.
Catherine, very quickly, I mean, when do we worry about U.S. debt?
We were just having a conversation about this.
Yeah.
You know, it's a dismal science, economics. It can't tell you a specific number where markets get nervous, and it all comes down to credibility. At what point is the fiscal outlook no longer credible from an investor perspective? When does it look like, you know what, I'm not really sure I'm going to get paid back? And it's so difficult to put one's finger on that. But when it happens, it tends to happen very quickly. And this has been a question that has come up a lot. So clearly the risk is live. To me, the acid test is growth. As long as the U.S. economy is growing, and it grew at a really good clip in 2024, as long as we see that growth, and that growth also looks like healthy, sustainable growth that's coming from investment. So you're growing not only today, but the chances that you're going to grow a lot tomorrow are sort of being hardwired in through that investment, through the labor market. Then that credibility, I think, can withstand. Once you see chips in that, I think you'll get the concerns.
Okay, guess what? We'll talk about the UK next. Catharine Neiss from PGIM and Derek Halpenny from MUFG. This is Bloomberg. Still with us, Derek Halpenny from MUFG and Catharine Neiss from PGIM. Derek, we're talking about debt in the U.S., debt levels. How do you see it playing out?
At some point, again, going to Catherine's point earlier, you can't say exactly when, but I feel it's coming maybe sooner and possibly this year, that those cyclical factors that we spoke about. Investors don't care about deficits when growth is strong. They care when growth starts to weaken. And when you look at the figures, they're mind-boggling. Debt servicing costs going to be over $1 trillion. That's more than the entire budget deficit in 2019. And then when you look at the first 2 months of this fiscal year, the deficit is up 20% when you strip out timing issues. And these are supposedly good times. Why is that happening? And at some point, you may start to see the economy slow, but rates possibly, certainly not coming down, maybe even going up again. And then that's when I think investors start to take fright. That's when it starts to have a bigger impact on asset prices. And then very quickly it can start to unravel and become a bigger issue for the markets.
And the catalyst?
Well, who knows? If we did, I think we would be doing well. I mean, it could be, potentially coming from Europe. We've seen a lot of issues around debt sustainability in France. We had in the UK this Liz Truss moment. And I think, these sort of sentiment shifts can happen in a way that are unpredictable. If we saw, that France, for example, I think is going to be in a very difficult spot for at least the first half of 2025, if that acted as a trigger for market sentiment that got eyes to focus more directly on the U.S. and say, hang on a minute, the fundamentals here just don't add up, and I'm getting nervous, that could potentially be a trigger.
All right, thank you both for joining us. A lot to think about for the start of the year. Derek Halpenny, Head of Research for Global Markets, MEA, and International Securities at MUFG, and Catharine Neiss, Chief European Economist at PGIM Fixed Income. Coming up, we take a look at what lies ahead in 2025 for global investors. We're joined by Co-Chief Investment Officer of Sixth Street, Julian. That's next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Donald Trump ramps up his foreign policy rhetoric, threatening to absorb Canada, seize the Panama Canal, and take control of Greenland. Nvidia gains pre-market after suffering its biggest single-day drop in 4 months. Plus, growing concern about inflation leads to a sell-off in Treasuries as yields march higher. So inflation concerns are weighing on the market as investors prepare for what's in store in 2025, including the new Trump administration. Our next guest remains bullish on real estate and tech innovation in Europe. We're joined by Julian Salisbury, the co-chief investment officer of Sixth Street, a global investors with $100 billion of assets under management. Julian, thank you so much for joining us. So you're quite bullish on the UK, which is quite refreshing because a lot of people think it's US first. Everything will go to America in terms of economic prowess and almost global supremacy, and everyone else will lose.
Look, clearly the US preeminence theme is strong, and it's hard to see what's going to reduce that. You look at what's happened to relative market caps, relative valuations. But that doesn't mean there aren't great investment opportunities here in Europe. When I was here 6 months ago, we talked about this higher for longer environment was going to keep asset prices under pressure. It was going to result in more capital structures needing amending. But I also think, we talked about then, this was ahead of the UK election, that notwithstanding the uncertainty of the outlook, that, we were going to find opportunities to invest here in Europe. And we were very active during the course of 2024. So, we're putting our money where our mouth is as well. We made a couple of the larger investments in the UK, one in real estate, one in private equity. We were very active across our direct lending franchise. So it's not at the expense of the US, but I'm saying just because the US is very interesting and exciting, there's a lot of things attractive about their market, doesn't mean we can't find areas to deploy in Europe. So
what happens in 2025? Will you deploy more money in the UK compared to the rest of Europe?
Look, again, if you think about the way our business is set up, we don't have a specific day one or the beginning of the year asset allocation. We want to put X in UK or X in Europe or X in the US. It's more about bottoms up, originating great deals, companies with strong unit economics that are capable of withstanding a variety of economic outlooks so that we're not subject to the vagaries of rates being up or down 50 basis points, policy tariffs influencing things in our portfolio. And if that, last year, it just so happened that there happened to be a couple of very large investments in the UK. It may be that there are none in 2025, but my expectation is that we'll be as active, if not more active, in 2025 as we were in 24.
10 billion? Less than 10 billion? Give me a number.
Well, so last year, it was 2 billion euros that we deployed across our direct lending franchise. That was pan-Europe, across 13 different transactions. We had on the real estate side in the UK, it was a little north of 1.5 billion. In the private equity space, a little over, it was one large transaction towards the end of the year that was about £400 million. So, that gives you an order of magnitude of the scale of the business last year, and I would expect to do more during the course of 2025.
Julian,
as long as opportunities present themselves that make sense to us.
I was going to ask about opportunities because you see, the UK is in a debt concern trouble. And, of course, if you speak to our chief economist, he says, look, debt levels are rising across the world. It's just as soon as the market loses faith in the UK, then it spells trouble. Does that give you more opportunities? Look,
I think we talked about this 6 months ago, right? That there are concerns about that we share about the UK economic outlook, but that also results in less capital being here, less vibrant capital markets, less highly valued public markets, less active public debt capital markets, less private capital. I mean, there's certainly competition here around every deal that you look at, but on a relative basis versus the US, less. So I think that concern or reservation about the UK means that we're able to find great things to do. I mentioned one deal, Wingstop. It's a franchise, a chicken franchise business here in the UK. It's a great entrepreneurial story. It's a story of 3 UK entrepreneurs who started a business from scratch in 2018, built this thing up using family office money, private capital money. The company needed to move to the next stage of growth. They'd outgrown their existing capital sources. We step in and provide them private capital to continue their journey for many years to come. We think they have ability to multiply in size from where they are today. And at some point, there may be a public exit option, there may be other opportunities. But it's that business is such a secular grower. You know, UK growth plus minus 100 basis points, rates plus minus 100 basis points doesn't really matter.
And no concern about, you know, capital leaving because of non-dom rules or the budget. And again, does that make more attractive to find assets, or is it still a question mark?
Yeah, look, I think we talked about this last time. I think the UK should be embracing its historic position as a centre for finance and trying to encourage more people to come here and attracting talent rather than pushing them out of the UK. You may not notice the damage that that's doing immediately, but, you know, 5, 10, 20 years from now, it'll become obvious. So I think the UK should be doing everything that it can to bring investing talent and financial services talent, or keep it in the UK and attract more back into the UK.
But what do you think? I mean, do you have a clear understanding of what the UK economy wants to be? So is it manufacturing? Is it entrepreneurs? Is it legal services?
Right.
And again, you know, given that, does it mean that you go for different opportunities?
Yeah, again, it's very, for us, rather than having a broad kind of policy about we're going to go into this
and
sector,
that,
it's many of the deals we look at here are quite opportunistic in nature.
Finding the right deal.
Finding the diamond, you know, in the rough, finding the needle in the haystack. So
and that's what good founder, a good CEO?
Yeah, look, again, the one deal we did earlier this year, Carla, it's a home builder. It was owned by an insurance company. They were looking to recycle capital. It was a win-win for them. They got to sell what they deemed to be a non-core asset. We got to buy a great business that we thought was a reasonable valuation. We think there's secular growth ahead of that business. We may not do another deal like that. It was a bit of a one-off. The deal that I mentioned with the Wingstop franchise, we happened to know that company very well. We had an existing relationship with the US business that gave us particular insight into the business. We may do, you know, one more of those next year. We may do 0. It's very much like idiosyncratic deal by deal.
Julian, anything in Europe away from the UK?
Look, I think across Europe, as I mentioned earlier, we continue to be active in our direct lending franchise. This is supporting a variety of sectors. We continue to be strong in B2B enterprise software lending, but we also are active across healthcare and other areas. Some of that's sponsor-backed activity, some of it's non-sponsor-backed activity. I do think that we're likely to see a higher level of M&A activity in 2025 than in 2024, so that will be supportive of us growing that business broadly as we support our sponsor clients across the region.
Julian, thank you so much for joining us. Julian Salisbury, their Co-Chief Investment Officer at 6th Street. Now, coming up, we'll hear exclusively from the EU's industry chief, Stéphane Séjourné, with his thoughts on the upcoming Trump presidency. That's next, and this is Bloomberg. Now, the EU must be ready to defend itself from possible punitive trade measures from the new US administration. That's a very clear message from the EU Commission's Executive Vice President, Stéphane Séjourné. Now, he spoke exclusively to Oliver Crook about how the bloc plans to respond to the new administration.
Europe will remain an open market and will not become a closed one. There's no gain in a trade war. However, Europe cannot be the only continent open to global overcapacity. Across the globe, markets are increasingly protective, with state aid marking our industries uncompetitive. This must be addressed. We have both offensive and defensive trade instruments that we must activate as part of a comprehensive economic strategy. This marks the end of European complacency or excessive openness. We need to protect our industries when they are not operating on a level playing field.
And one of the great risks to the European economy and indeed to European industry will be tariffs that have been promised by Donald Trump, obviously something that you're paying very close attention to. I want to ask specifically about steel tariffs, because if there is no deal by the end of March, as you know, there will be steel tariffs between the United States and Europe. Are you prepared to support European industry if that comes to pass?
Regarding steel, there is no automobile or wind power industry without steel. So if we want to be able to build automobiles and wind turbines in Europe, for example, for carbon neutrality, We need a European steel industry. We will have a plan to protect the steel sector from global overcapacity while ensuring competitiveness. I'm prepared to explore both defensive and offensive actions with my colleagues at the Commission. This is a dialogue that we will have at the Commission. I still hope to convince the next U.S. administration that we have everything to lose from a collective trade war. Europe is an economic power with 450 million consumers and must be viewed as such. Our goal, our responsibility, is to be united as 27 nations to be able to negotiate.
Now, the EU Commission Executive Vice President Stéphane Séjourné there. Well, Bloomberg's Oliver Crook, who did the interview, joins us now from Brussels. So, Ollie, good morning. European industry clearly under threat. Do we have a roadmap on how to support it?
Yeah, so listen, Francine, it was really interesting to speak to Stéphane Séjourné, who is the Executive Vice President for European prosperity and for industrial strategy. This is a new job that has been developed under this commission, and it's really supposed to be the executioner of much of the Draghi agenda on the issues of competitiveness, yes, for industry, but really across the sort of wider map. I think that what we got from Stéphane Séjourné and what is more about the sort of not the specifics of what the exact levers that they're going to pull policy-wise, but more of an understanding of how they're going to sort of begin to attack this. I mean, he's been in the job for about 40 days. And really, I think that the challenge for him and what he's sort of trying to do is to bridge this sort of gap that exists between the old industries of Europe, i.e. heavy industry. We talked about steel, we talked about aluminum, the auto industry, as well as sort of the chemical industry, bridging that to the sort of industries of the future. So making sure that the old industries of Europe don't die and that there are enough of them that still remain in order to service some of those new industries like, say, renewable energy, say, wind power. But there are a lot of those industries where Europe is way behind, whether it's battery technology, whether it's solar panels. These are not places where Europe is winning right now. So that leads to the next question. Part of the Draghi agenda is spending a huge volume of money every single year to try to achieve those ends, up to 800 billion euros. The other question I asked Stéphane Séjourné is that achievable? Is that realistic without joint debt? Have a listen.
Yes, it is realistic because, first of all, if we add the competitiveness policies of each member state plus the European budget, we're not very far from the investments that need to be made. I will push to implement the whole Draghi report and nothing but the Draghi report, all the components, including the investment aspects.
And so part of his task is going to be unlocking additional funds. Could they set up additional direct investments funds at the EU level to help member states sort of make these sort of strides that they need to do towards more competitiveness? And that is really going to be the sort of the task for this agency going forward. And we're going to get a lot more detail on that when we get the clean industrial deal that'll be published at the end of February.
So, Ollie, what are the biggest obstacles to the competitiveness agenda? Does it always come back to money?
Yeah, I mean, money is certainly one of the big ones, Francine. That's one that's sort of a big focus. I think that one is also in part of the nature of the EU, how slow these things move, how much consensus you need. Let's also remember that the EU functions very differently. It's not a national government. It's not like in China where you can have a lot of direct state-backed action that is unilateral and is just kind of do whatever you want. It's not like in the United States where you have the Inflation Reduction Act and you can create all these sort of tax incentives. The EU doesn't quite work that way. So it's not as clear the way that they can sort of pull all of these levers. The other problem that we have, Francine, in Europe is that there is just not this sort of political unity that there is in order to make these great strides forward, these leaps forward in terms of European unity. I mean, look at what's going on in France, look at what's going on in Germany, and also let's not underprice what's just happened in Austria. We have a situation where now another leader of a 27 euro state, these are people that are making decisions, sitting at the table. The next chancellor, potentially a sort of far-right Herbert Kickl, the head of the Freedom Party, he is not going to be on board with moving forward these sort of collective European projects. This is a Eurosceptic. There is also the question, of course, of Donald Trump, which makes things a lot more difficult from an economic standpoint. But I think the hope for many European leaders is that the pressure that Trump ramps up on the European continent will have to force to bring these states together in order to make collective action and to be a sort of collective, cohesive bloc in the face of what could be some very challenging few economic years versus Donald Trump.
Ollie, thanks so much. Oliver Crook there in Brussels. Now, Elon Musk is settling his sights on Europe, having successfully worked to get his candidate elected in the U.S. Now, the Tesla and SpaceX billionaire, who's set to lead an advisory body for the new Trump administration in Washington, has actually embraced misinformation and conspiracy theories while criticizing the governments of the UK and Germany. Let's bring in Bloomberg's Alan Crawford in Berlin. So, Alan, what's been the response in Berlin and London?
Well, governments have been really put on the back foot here. On the one hand, they're kind of silently outraged, but they have to be very careful what they say. They essentially are, it's very unclear in what capacity Musk is speaking. Is he speaking on behalf of Trump? It seems kind of unlikely. What does he actually want? Well, he's not making that very clear either. So governments are really treading on eggshells here.
So what's the impact? And actually, can he bring about change? Do people believe him? Does it change policy or thinking?
That seems extremely doubtful. Yes, in Germany, which has been one of the focuses here, he's been slamming the Chancellor as a fool, the President as a tyrant, and he's publicly endorsed the far-right anti-immigration Alternative for Germany party. Then there are elections here next month, but it's not really showing on the opinion polls. It's hard to really see how this might play out, apart from perhaps hurting his sales of Tesla. There's a big Tesla plant just outside Berlin here.
So why is he doing this, and what's the end game?
He's not making it clear, and he's being rather inconsistent in terms of the kind of forces that he's endorsing. As you saw a few days ago, he just broke with Nigel Farage of Reform UK. But the analysts that we spoke to were suggesting that they used the term that he'd tasted blood in terms of shifting his business clout into the political sphere. He, of course, backed Donald Trump with large sums of money, campaigned for him. It was ultimately successful. And so now he's training his sights on Europe to see essentially how far he can push the boundaries and test the European establishment, shake it up in a libertarian way.
Alan, thank you so much. Alan Crawford there in Berlin with the very latest on Elon Musk and, of course, European leaders. Now, to some other stories making news, and we start with the sister of Sam Altman. She's accused the OpenAI chief executive of sexually abusing her for almost a decade. Now, in a lawsuit filed in federal court, and Altman alleges that her brother abused and manipulated her while they were growing up in Missouri in the late 1990s and early 2000s. Now, in a statement on behalf of himself, his mother and brothers, Sam Altman called the claims utterly untrue. An uncontrolled wildfire is threatening densely populated Santa Monica after ripping through an affluent area of Los Angeles. Now, the Palisades fire was at almost 3,000 acres, while two other blazes flared up overnight, one near Altadena and the other near Silmar, southeast of Santa Clarita. All are uncontained and have prompted evacuation orders. We're getting live pictures in, so of course we'll be following the story very, very closely. Up next, we talk about fixed income, new year, new bond issuance. Global credit markets have seen strong demand, with investors willing to settle for low-risk premiums. We discuss that next, and this is Bloomberg.
AI is going to reinvigorate the video game industry. On the one hand, for developers, it's going to reduce the cost of creating the content. On the other hand, all of the characters that are in the games are going to be smart characters in the future. So every time you interact with them, they're going to be interacting with you in a much more intelligent way.
Now, that's the NVIDIA chief executive, Jen-Hsun Huang, speaking with Bloomberg technology co-anchor Ed Ludlow. So borrowers are flooding global markets, debt markets, at an unprecedented pace as they take advantage of demand for credit-hungry managers flush with cash. Now, for more on this, let's bring in Bloomberg's Valerie Taital. So, Val, first of all, and we'll talk about debt in general, because there could be a debt bubble that people need to worry about. But what's corporate debt looking like?
Look, there is a lot of appetite out there. It isn't, I guess, unusual that we see this big issuance boost in January. A lot of corporates try to fluff up their balance sheet with cash at the beginning of the year in order to sustain all their financial targets for the year. But what is unusual about this is there is voracious appetite from investors, while credit spreads are near 30-year tights. Some of the credit spreads are at historic tight levels. So it's very surprising to see this kind of appetite where there isn't much pickup over, let's say, holding a treasury, holding a government bond. Those really tight levels are still seeing appetite out there from the market. And a lot of that has to do, Fran, with just the fact that we're not very much worried about default risk anymore. If you think about this time last year, for example, we were still having worries about a U.S. recession causing perhaps a global economic downturn. We don't necessarily have those worries. So that default risk has really evaporated, I guess, on a global basis, so allowing these historically tight levels to get even tighter in the face of all the supply.
When you look at government debt, I mean, this is the huge, big concern. We just had a great conversation with PGIM and MUFG about the fact that a lot of this government debt, if you look at the policies that Donald Trump also wants to follow through, it's just a lot more issuance. A lot will come, for example, in the UK in January.
Yeah, that is definitely a global narrative of swelling budget deficits, these over-indebted governments. So it's a very different picture when it comes to government bond supply. So far this year, it's not been absorbed very well. We had the 10-year auction in the U.S. It had the largest coupon since 2007, the highest yielding coupon since 2007. And then we had a 30-year bond auction here in the UK, which didn't see very good appetite. So while we're seeing a good appetite for corporates, it's very much a different picture when it comes to governments. And frankly, it's because the balance sheet of governments is just not looking as healthy. If you take the UK, for example, tax receipts, which in some way are a measure of economic growth, they're not growing. But what is growing is the interest payments that they're having to pay on their debt pile. We saw those 30-year yields yesterday hit highs they've not seen since 25 years. And the average maturity of the UK's debt pile is 15 years. So they're very much exposed to this steepening of curves we've seen, this global bond route that's been led by the long end. So frankly, government's balance sheets aren't looking as healthy as the U.S., which is driving that difference.
Valerie, thank you so much. Valerie Teitel there. Now, there are live pictures from Malibu, California, where an uncontrolled wildfire threatening densely populated Santa Monica after ripping through affluent areas of Los Angeles.